This is an interesting sort of thing. Again, I want all of you guys to sort of move on from, how to put this, novice. There's a sort of slang word for novices in computer culture, but I won't use it here. I'd like you to move on from sort of novice investing to being sophisticated and sort of a little bit more professional. And the Fama-French model is something that in, 17 years of hedge funds, I have not seen once. And I think that, it's one thing for a group of internet observers to not be sophisticated in finance, but it's another thing for the financial industry to not be. Now, granted, the financial industry has been taken over by quantitative investors who are no doubt very thoroughly versed in Fama-French, but I'd encourage you to look up some of the Fama-French literature that's out there. And I think that you'll enjoy it, because the Fama-French model is just a simple, you can see it's sort of this regression that allows you to sort of predict the return of a stock based on, interestingly, unlike CAPM, a couple of interesting metrics here, like the size and the value of the company. So price to book, or the market capitalization of the company, which is really kind of a cool model. And you can play with your own models. And I want you to start doing stuff like this instead of thinking about technical analysis or thinking about what people are saying about a stock on Twitter or thinking about stuff like that. There is a real science to investing. And I'm not saying that you have to be you have to think about these in some monolithic or holy way. There's nothing holy about Fama-French at all. But I think that, it's really important to think about factors and investing from a different perspective. And, people ask about Bitcoin or marijuana stocks, and it harkens, or at least I think it speaks very poorly about the person who's asking about it, because instead of a prescriptive thought process to tackle investing, what you're really doing is reacting. You're reacting to emotion. You're reacting to things you hear about, and that's the worst possible thing you can do, because investing should be tackled procedurally. If you're going to build a building, you wouldn't start right away and say, all right, well, I think the Leaning Tower of Pisa is a good building. Let me start building it. And you start building it, and you say, oh, maybe the Sears Tower is a good building. You start building it like the Sears Tower. Your building won't be a very good building by the end of it. And I think that people are scared to sort of look at a big system like the stock market and break it down and have a strategy where they say, all right, this is how I'm going to tackle this crazy stock market. This is how I'm going to start to think about what value I can bring into the world, and including my time constraints, and plan out in a sort of battle plan. And for me, what worked relatively well was taking a sliver of the market, the biopharmaceutical market, which is about 10% roughly, maybe 15% of the stock market, and saying, I'm going to be really good at this 15%. And by focusing on that 15%, I was able to sort of divine some insights and things like that. But I think that, just picking up the phone and talking to stockbrokers and talking to your friends who may be at hedge funds or mutual funds or maybe like to invest a lot and maybe got lucky and you're following their picks, that's a great way to lose money. You're not taking a thoughtful approach to the market. And again, I encourage you to read the very arcane and dense things that get published, like in the Journal of Finance, which I think is one of the highest impact factor. If you guys don't know that term, impact factor is a pretty cool phrase. So finance, journal, impact factor. Journal of Finance is 5.29. You can actually kind of look these up, and you can see that here there are, crazy, there's 214 total journals, but in the Journal of Finance is good head and shoulders above the next couple of ones, but these aren't bad either. And if you read these, largely academic, but occasionally someone like an AQR or someone will publish in one of these, you can learn quite a bit and start to take yourself out of that whole ridiculous culture where you're Googling for good stock picks, or you're thinking about and again, I'm not insulting anyone specifically, but when someone buys dry ships or AMD or something like that because they heard about it from somebody, that's we all know how that movie ends. But I'm not telling you that professionals are any different. Professionals have a word of mouth system on Bloomberg or AOL Instant Messenger or other tools, the phone, and they follow each other. And I would tell you that a good portion of the world's money is invested this way. And the quant investors are kicking the butt of the fundamental investors, but that's not because quant is better than fundamental. It's because fundamental investors often don't have a process. Their process is, let me look at whatever Goldman Sachs is telling me to look at this morning, or what the guy at so-and-so hedge fund capital management is looking at this morning, and that's the error. Having a process that's mathematical and procedural and logical is sort of what I think makes the most sense. And some of these journals may help you, not specifically because you're going to employ Fama-French and make $1 zillion, but you may become more systematized, and I think that's what I'm trying to teach everyone in general. All right, so I got an enormous number of questions, and I want you to keep them coming, and I'm regretful that I can't get through all of them, but I'm going to try to get through more of them over time. But I think that there's a limited capacity for me to answer every question, so I'm sorry if I haven't been able to do them. I can't even read every question, which is somewhat remarkable. But anyway, one question I got was a pretty simple question. What is the best way to short a stock? Should I use Chris asked this question, and he said, should I use derivatives? Should I use puts? In other words, should I short the common stock? Should I do some kind of hedge? And it really depends on what you're trying to do. In general, I just like to short common. It's the easiest thing to do. Don't overthink things. I think that's the simplest way to short stock. That's what I do. ESG is environmental, social, and something metrics. And there's a Goldman Sachs, I guess, webcast or podcast, which I wouldn't listen to. It's just Goldman Sachs advertising that Phil asked about, that maybe that these metrics are actually the ones to look at, that maybe there would be some benefit to investing in companies that are doing social good and I don't know, environmental good. I don't think that's a good idea. One of the best ways to think about math is to in other sort of pieces of logic is extreme views. So if you take the extreme variable in this function and you say, okay, well, will the most environmentally sound and the most socially good company make you the most money, and vice versa? And if you think about it in the extreme, those don't stand to reason. The companies are not meant to be environmentally sound or socially aware or anything like that. Governance. Well, governance does matter. I'll you know what? I'll make this maybe lowercase e and s. Governance is important. Governance is very important, but I think governance is part of management. So I think that that's something to think about. But in terms of environmental and social, I think there's a sort of a difficulty in tying that to reality. Thank you for this meme, by the way. This is, I guess, Ty Lopez, who I don't know what he does other than make advertisements, but I appreciate the meme. Olsen. A lot of people ask me for a general model. Make your own. I have a 20-hour series about modeling, or maybe more than 20 hours, like 40 hours. Make your own and send me your models, and I'll compare them with mine, and I'll maybe I'll send you one back, but if you just want me to do your work for you, I don't think that's going to work. Someone asked me about multivitamins. I do not take any multivitamins. Even a diet like mine, which, as many of you know, is not very good, has all the vitamins you need. Someone here, I think his name is Todd Todson, is I guess disagreeing, maybe to put it bluntly, with some of my views. You're welcome to call me if you have any guts. You can dial my phone number 646, and I would love to discuss this further with you. Unfortunately, many of the people who disagree with me are challenged with respect to testosterone and are unlikely to back up the things they say. I have to edit myself a little bit. YouTube doesn't like any profanity in my videos. So in any event, I hope that you summon the courage, Todd, to call. But just let me know what your phone number is beforehand so I can just pick up that call, and I'd be glad to roast you in a very professional way. Someone asked me about Gilead M&A. Someone said, oh, well, Gilead's being too passive. Oh, no, I'm sorry. Someone said, what would you do if you were the chairman of Gilead? Okay, thanks, Elias, for that question. I do think Gilead's being a little too passive, but at the same time, it's easy to say that in hindsight. And obviously, this is a company that bought, they bought of course, Pharmasset to get 𝐉𝐚𝐳𝐷, and they made $50 billion in the process. So it's pretty hard to criticize them. And I think when you have investors like that, whether it's Gilead or Berkshire, of course, everyone wants Gilead to make some big move, but I think that, let's wait and see what they do. Let's give them the benefit of the doubt, right? Is Shopify the next Amazon, or are there other next Amazons? An intelligent question from Dustin. Obviously, I don't think Dustin was implying that Shopify was necessarily is necessarily the next Amazon, but nevertheless, I actually don't think that Amazon will their retail business will last forever, but their fulfillment network, I think, will. I have a lot more to say on that, but I kind of want to do a startup around this, so I probably should keep it to myself. I do think AWS is here to stay, but I do think that shopping on the internet has not seen its last days in terms of innovation, and there's a lot more to do. Whether Amazon does it or somebody else does it, we'll kind of see what happens. With respect to the weekly Bitcoin and crypto questions I get, it's a little frustrating to get a lot of them. Hold on half a second here. It's a little frustrating to get most of them because they're sort of a bit overwhelming, and they're all sort of come from a naive perspective. Again, I think you should, for every Bitcoin question you have or fascination, I don't know why the fascination for it. Basically, there are way more interesting things to think about. Why don't you go ahead and learn about Fama-French and other important and interesting things about the market than worry about Bitcoin and cryptocurrency. I don't think one is taking a serious study of all markets if you're just asking questions about Bitcoin. Someone asked me about SGYP, which is the Synergy Pharmaceuticals. I don't like this stock. I think any kind of IBS drug or mass market drug is not going to do too well. So anyway, sorry to dunk on you, Evan, but SGYP is not a good long at all. AVXL is worse than Neurotrope, which is saying something. Sorry, the person who asked that wanted to remain anonymous, but that was a big sort of a big issue. AVXL is a big problem here. So, in any event, let's keep going here. How do you select a discount rate? My answer to that is, what's the meaning of life? Andre is asking the question. So the core to all finance is, what's the discount rate? I mean, in essence, that's really, you're basically saying, how do I measure risk? Well, wouldn't we all like to know? Everyone wants to know what discount rate to use for what asset. It's a really tough kind of it's a tough thing to understand and learn. So really difficult to answer that question, because it's a question everyone wants to know. Everyone needs to know that, and discount rate is really a mysterious and nebulous thing, and it's hard to answer that question really any more than it is to answer the question, what is the meaning of life? Should we invest in index funds? So I don't think so. Hassan asked this question. I've given some videos on this. I think it's better to have liquidity, and of course index funds are liquid. So what I mean by liquidity is that you don't have the impact of the market's gyrations, and you don't have the risk of being whipsawed, which I think is the risk of being long only. You're at the mercy of the market. You can sleep at night and focus on growing your primary earnings. It's a message that I've had for some time. I don't think you should expect any excess return from basic index passive investing. Sean asked me about marcajones and negative activism or short selling activism. I'm a big fan of it. I've done it for many years. I'm sort of surprised by the question. Of course, I like it. I've sent stocks reeling by just my very tweets. So of course, I think what Mark is doing is constructive. I like Mark. I talk to him here and there. I think he's a very good investor. Tim asked about using 13Fs to invest. I don't think that's a good idea. Looking at some hedge fund like Greenlight or 𝐈𝐧𝐼 or somebody and saying, oh, I'm going to buy their stock picks. I think that's a terrible idea. If you really like a manager, you should invest in the fund. If you can't afford to do that, then I don't know what to tell you. But it's certainly not a horrible thing. But please, just try to do your own research and think very carefully about it. Most investors are right 55% of the time. So there's no great way to really predict kind of where a stock will go based on who owns it. One question from Rob, which I think missed the point, but it's instructive nevertheless, is do you separate your investments into stocks you think are mispriced versus stocks you think the intrinsic value will change? So the two are the same thing, really. I mean, intrinsic value isn't supposed to change. That's why it's intrinsic. The value of a company includes the future expectations. So if you think the future expectations are going to change, it's sort of a circular logic. They should already be embedded in your forecast. So there's no great way to kind of answer that question, and it sort of misses the point, I think. So I'm reading 3 books right now. One's called, I just got it from a friend of mine. Thank you so much for sending me this. It's called A Madman Dreams of Turing Machines, and it's actually fiction, which is kind of interesting. The Innovator Solution by Chris Christensen, or whatever his name is. I don't love it. And then Breaking Rockefeller, which I think is a really neat book. And then I want to recommend 2 kind of websites, if you will. One is the MIT Technology Review, where you can easily kind of find that. And then Greg Manikow's blog, which is an economics blog, which you might enjoy. So please take a look at those. Joel asked a great question. Any software out there that helps with planning or procedural approach? I mean, I like to make my own, and maybe Godel will do some of that. Who knows? We'll see. Yeah.
I'm hopefully going to be working in a hedge fund. I'm 19. I have a few interviews set up per week, but I'm really worried about the future aspect of quantitative investing. I want your opinion on that.
Sure. Yeah. No. Quantitative investing is one of these things where the firms that are doing it are doing really well. So I wouldn't get too worried just yet because they're really beating the pants off of kind of fundamental investors. And of course, it's a little silly to talk about quantitative versus fundamental because the best quantitative investors are heavily fundamentally factored. So I think that basically using a computer to help you do your job is not something that should be surprising that those investors are doing better than those who aren't, right? I mean, if you think,
yeah, of course.
If you think about it, that's really the secret sauce of quantitative investing is it's automating some part of the investment decision process or even all of it, but it doesn't remove the process. I mean, the process still exists. And to the extent that markets are very slow to react, I think there's still a good 10, 20, 30 years left of excess returns in quantitative investing. And I certainly, I think the more math you can learn and the more statistical methodologies you can learn and the more literature you can familiarize yourself with in the quant field, I mean, I think you're being very intelligent by doing that instead of, say, quote unquote value investing, which again, there's good values out there. I mentioned in my last call that markets are usually efficient, but sort of 1 out of 10 times they shoot in the wrong direction. So 2 out of 10 times a stock will be either overvalued or undervalued, and 8 out of 10 times most stocks will be fairly valued. So I think that there's still a way to invest that will make plenty of money, but the long short business, the value investor hedge fund business has such a sort of issue with kind of sort of being successful in making money, and you can see that where funds like 2 Sigma, Renaissance, and D.E. Shaw are making lots of money. Funds like Greenlight or Pershing Square or other sort of value investor type hedge funds are not doing so well. And again, there's plenty of value funds doing well, but in general, I think you need to start integrating some automation and some techniques. It's sort of like trying to run any kind of other industrial company, like a fast food company or retailer or whatever, without using technology. You'd be a little crazy. You could get it done, but in general, where would Walmart be without their IT system? I mean, it'd be really hard for JP Morgan to run their bank without automated loan systems and things like that. So anyway, that's my answer. Appreciate the call. Got a few minutes left here. There's a few more questions here. Do you think equity beta or correlation is a misleading factor in evaluating risk? So yeah, I do. Thanks, Bon Vivant. I'm glad you read the Super Investors article that I recommended last week. Correlation is extremely misleading. It's good for quantitative investing. It's really good for quantitative investing. But beta without some sort of interpretive guide is a really tough kind of thing to look at. It's the same reason selling premium works until you blow up selling premium. It's not predictive or causal of anything. It's backward looking, and it doesn't necessarily, at least individually, give you much perspective on the risk of a company's assets. But it does, with a big system, it sort of helps you quite a bit. I mean, something with high beta is probably riskier than something with low beta, but it doesn't mean that a high beta stock can't all of a sudden become very de-risked and a low beta stock can't get very risky very quickly. So conflict of interest, there's a lot of conflict of interest out there in the world, and you got to be super careful and watch for it. Cybersecurity companies considered tech companies or defense companies. Well, that's sort of getting blurrier and blurrier, is it? What's the best way to join a hedge fund? Don't. I don't know why you'd want to. Become a math expert and you can join a quantitative hedge fund, but other than that, I'd sort of avoid it. Why short Twitter? They don't make much money, if any, and the business isn't growing, revenue's declining. It's a big problem. We'll see what happens. I will be uploading this in a minute. I have no money. How do I make money? I've talked about this before. Just do your best to get good skill sets out there. And someone will pay. Doesn't Warren Buffett talk about growing intrinsic value instead of market price? Well, intrinsic value is in many ways, if you think about it as book value. Book value will grow over time, but fair value assumes book value grows. Every business that creates cash will have an increasing intrinsic value. So it's really not that interesting. The Boring Company, I don't know. I don't know what will happen with Elon Musk and his stuff. It'll be interesting to sort of see what happens. Best skill to have in this current age? Same skills before, probably. Mathematics, philosophy, logic. Extensions of that include, computer science. In your investing career, if you've been long or short more in biotech stocks, I'd say pretty even. Pretty even. Would you work in Africa? No, I would not. Chinese internet stocks look pretty exciting. They have less transparency than American ones, but they're benefiting from some of the same dynamics. What do I think about religions and God? There's some questions that I'm not very good at answering. Do I read quarterly hedge fund letters? Not really. I think 90% of hedge funds don't have a lot to say, and the returns would prove that. Does an inventor or product developer need a team to become successful as an entrepreneur? Yeah, usually. What's the average length of one of your stock trades? Probably about 6 months. 3 months, 6 months, something like that. Maybe 6 months. Am I a feminist? Sure. Why not? Depends on your definition, I guess. Yeah, I like 6 month moves. They're pretty. 3 months. You always want the moves in your stocks to happen as quickly as possible. But do I hedge? Of course. I have a lot of longs, a lot of shorts. I'm hedging beta. I trade options sometimes. Sure. Chinese medicine is interesting. 𝐉𝐵𝐸 is a snake. All right. Well, I really appreciate everyone joining in here. I went through it a little quickly. I think there was an hour of content, but I sped through the first 15 minutes pretty quickly there. So anyway, thanks so much for joining me, and we'll catch you next week, same time.